For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions because a smart non-billionaire like you is who succeeds in the market when you make informed decisions. Welcome to the Wall Street Exclusive Daily Show. A happy Purim to you and your loved ones. I have 4 pieces of information for you today to help you succeed in the market. The first is a low-risk, high-reward opportunity in the broader markets due to negative real interest rates. 3 of the things we talk about today are about negative real interest rates, a big upside opportunity because of negative real interest rates. Number 2, an opportunity to sell stock insurance to the fearful. Haven't you always wanted to sell insurance anyway? And again, that's negative real interest rates there. Looks like it's giving us an opportunity to do that. Number 3, we'll look at the cybersecurity stocks. We'll break down the big 4 that have been making news. And number 4 is gold. We actually think gold is going to do well from here, especially if you try the strategy we recommend. Okay, let's get to it. Number 1, there's a big low-risk, high-reward opportunity in the broader markets right now due to negative real interest rates. Okay, 3 points I want to make on this first main topic. Okay, the first point is that unattractive negative real interest rates in the bond market are here to stay for the foreseeable future. That's the first. Number 2 is the persistence of negative real interest rates that are here to stay for the foreseeable future will continue to support the stock market. We'll talk about why. And then the third thing is that because of that, there looks like a low-risk, high-reward opportunity for stock market bulls. Okay. The first point there, unattractive negative real interest rates in the bond market are here to stay. Negative interest rates around the central banks around the world are creating negative real interest rates. People want safety. They want to be savers. They want to sit in bonds or something safe. The problem is the world economy is facing secular stagnation and does not have some of the tailwinds of the past, like an ever-increasing labor force. Against that backdrop, central banks have eased. What does that mean? What they're trying to do is force people out of these safe assets, out of safe treasury bonds, and by forcing them out of that, they're trying to make those assets unattractive. And they're doing that, they're trying to make those assets unattractive by buying them up. For example, the U.S. Treasury sells bonds at auction, and then the Federal Reserve will go in and bid them up. So let's say the U.S. Treasury auctions a bond with a $100 face value and a 3% coupon. That means that bond gives you $3 a year. Okay, and you go to the auction, you're like, I'll pay $100 for that, and you want to buy that, right? But the Federal Reserve is there, and they say, we'll pay $200 for that. And it's like, crud. Now the going rate for that bond is $200. So if I want to buy that, it's not that $3 is now yielding me 1.5%. Well, what if inflation is at 2%? Then behold negative real interest rates. You're making 1.5% a year, but inflation is taking away 2% a year, so you're losing 0.5% of purchasing power every year. Negative real interest rates. So the central banks don't want people sitting in these safe assets. They want to stimulate the economy by getting people to spend or invest in stocks, which if you invest in stocks, companies eventually use that to raise money in different ways. Issue shares, IPO, issue shares in secondary market. Okay, so these central banks are trying to get people to spend and invest. That's the point of negative real interest rates. It's the point of quantitative easing. Negative real interest rates seem to be a feature of secular stagnation. This is what secular stagnation predicts: a lack of demand in the economy, not enough spending, not enough investing. And there's no end to secular stagnation in sight, maybe for a generation, maybe even more. Okay, so unattractive negative real interest rates in the bond market are here to stay. That's the first point. Okay, the second point is the strength of the bond market will continue to support the stock market. So why would people sit in these negative rates and lose money, sit in these bonds that have negative real interest rates and lose money? Well, strong hands own bonds. Institutions like pensions and insurance companies, and even the extremely wealthy, have no alternative or are required by law to have bonds, or are highly incentivized to take the least amount of risk, even if it means a small loss with negative real rates. Bond markets are unattractive, but they're not going to sell off because of who owns those bonds. Pensions, insurance companies, the extremely wealthy. They're not going to sell out of those bonds. And that means that rates will not rise for a long time, maybe a generation, a long time. So the stock market may be a little richly valued right now compared to itself historically, but compared to the alternative, bonds, the stock market has never looked so attractive. 10-year treasuries pay about 2% right now. In 2004 and 2005 and 2006, 2007, while the market was shooting up, the market was on a tear, the 10-year treasuries were paying about 4.5%, more than double what they're paying now. So you could get a nice, safe return in treasuries, and the stock market stormed ahead anyway. In the late 90s, the 10-year treasury paid almost triple what it pays right now. And again, the stock market soared anyway. You could get a safe and decent return. People went to stocks anyway. Rates have only been this low once before. They actually have never been this, how they've been in the last year. They actually did not go that low. The only time they've ever been close to this is in the Depression, and they didn't stay there very long. So with secular stagnation, very low rates to stimulate spending and invest look like the new normal. Very low rates look like the new normal. And so you've heard of like flight to safety. It means people buy US Treasuries for security. But the Fed has officially removed the safety. It's a flight to a guaranteed loss. And so, so what we could have here is, or what we do have already happening, I think, is the flight to the only reasonable return, the stock market. And it looks like it's only just begun. The price to earnings multiples of the average stock have gone from like 15-ish to 19-ish. So your average return went from about 6.7% to about 5.3%, 1 over 15 or 1 over 19. But that drop in returns for stocks pales in comparison to the drop in returns for bonds into negative real territory. The multiple expansion in the stock market has been steady and over a couple of years, and it looks like it will, it looks like it will continue to be steady. It looks like negative real interest rates will persist, and that unattractiveness in the bond market will continue to put upward pressure on the stock market. Average price to earnings ratios for the average price to earnings ratio multiples for the average stock should go into the 20s and stay there, maybe forever, maybe for a long time. The stock market has been going gangbusters for 5 years, but how it has performed relative to its own history will not determine where the stock market goes from here. The attractiveness of the alternative to the stock market will determine where the stock market goes here. And like we're saying, central banks of the United States and Europe and Japan, etc., will continue to punish savers to try to stimulate the economy. So negative interest rates are here to stay, and that is great news for the stock market, the only place giving you a reasonable return on your money. So the S&P 500 is at 210 now. It's up 2.28% so far this year. By December of 2017, if it keeps up at that pace, it will be at 308. Is that like ridiculous? Is that too much? Well, it's less than 50% in about a little less than 3 years. That's nothing new really or exceptional. So if the S&P 500 keeps up its rate of return that it's having this year so far, it'll hit 308 by December of 2017. That return could be conservative considering the persistent, very low interest rates in the bond market. The Fed is getting its way. Don't fight the Fed. Okay, so equities as an asset class are going to get more capital allocated to them because of the Federal Reserve. Thank you, Janet Yellen. You deserve a good thank you. So how to play it? Should I go on margin, borrow a lot of money and pay interest on it and then invest it and just hope everything works out? I bet actually that probably would work, but don't do that. Let's look at the options market instead. And then probably the best call option to buy there might be like the 280 strike or the 275 strike. But when you go out that far, 3 years, even on something extremely liquid like the S&P 500, the options aren't very liquid. So look at the strike of $250. That one is trading a lot. It traded today for $7.37. Okay, and then if the S&P 500, if we're right and the S&P 500 goes to 308, you get a $58. You get $58 for your 737, and so you've more than octupled your money. So if you're buying this, that this bond market is going to push, is continuing to support the stock market, and the stock market's got a long way to go to catch up. then 308 could even be low. Well, there's an octuple for you in less than 3 years, getting that 250 strike. That by the December 2017 250 strike call option on the SPY. You could look at that two ways. You could put all your money on that, which is a bad idea, and then get 8 times your money. Hey, that's pretty great. Or you could keep more than 90% of your money in whatever else, cash or something else, the VO, and then put just a little bit more than 7% of your money into something that could give you more than a 50% return. If it goes to 308, then you get 8 times on that 7%. So you've risked less than 10% and gotten more than a 50% return on your whole portfolio. Something to consider. In the next segment, we'll talk about how to finance that 737, and so the good ways to do that there as well. One other question: if astute viewers will say, Joe, you love the VO. How come you're talking about the SPY? And that's because the SPY is way bigger and more liquid, and its options go out way farther. If the VO had options like the SPY does, I would say go for the VO. If you can do it with the VO, go ahead, but look at how many options traded. It's like 5 or 10 or something like that. Okay, I hope you found that helpful. For the Wall Street Exclusive, I'm Joe Springer, helping you, smart person, make informed decisions, because someone like you is who succeeds in the market when you make informed decisions. Coming up next, we're going to show you how to finance that, buying that call option. And after that, we'll look at the cybersecurity stocks, and then we'll go to gold. For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market. Okay, we just talked about how to get the big upside with a call option. Now we're going to sell a call option. We're going to talk about an opportunity to sell insurance on stocks. You've always wanted to sell insurance. Okay, the muddled up bond market should continue to drive stocks higher, and at very least, it should put us a floor underneath the stock market, because there's really nowhere else to put your money that makes sense. If you sell out of the stock market, where are you going to put your money? The bonds, cash, you lose money. So money can't really flee the stock market too well, because it doesn't really have a reasonable place to go. Okay, so because of that, there's an opportunity to sell insurance in something of an advantaged way. If your opinion is that because of the bond market, there's really nowhere for the money in the stock market to go and has to stay in the stock market, but other people might be saying, you know what, the stock market's been rising for 5 years, I'm so scared, I want to buy some insurance. And so there you go. And so you know there's no better alternative to the stock market, so you can make some income selling insurance. So what we're suggesting here is selling short-dated calls on the very liquid SPY. So the S&P 500 Index Fund SPY, SPY, closed at $210.23 today. You could buy the SPY and write a March 20th call with a $211 strike for $1.50. What does that mean? Okay, writing a call just means selling a call, and a call is the right to buy a stock at a certain price, the strike price, by a certain date. So in this case, $211 was the strike price, and the expiration date is March 20th. And then, okay, so and so you got $1.50 to do that. So today, and I should say today, those stocks, that option traded for $1.50. Okay, so this is a real life example. Okay, so then, so you buy the SPY, you at $210.23. You sell somebody the right to buy from you at $211 for the next 2 weeks. If the SPY rallies for the next 2 weeks and goes to $215, then that person will exercise that option and buy your stock from you for $211. You should be happy. You sold for 77 cents higher than you just bought, and you got paid $1.50 to be in that situation. So you made more than 1% in 2 weeks. Over the course of a year, that's a good return. A very good return. If the SPY stays under $211, you keep your stock and you keep the fee. You keep the SPY and you keep the $1.50. Okay, in this way, you're allowing someone else to have the upside without the downside for a fee. So it's as if you're selling them insurance on the SPY. They can only lose the premium they paid you, and in that way, you are insuring them. Well, do I really want to give up the upside? Well, if you collected $1.50 24 times, remember this is about 2 weeks out, so you should be able to do this 24 times a year. If you collected $1.50 24 times a year and only broke even on the SPY, if you bought the SPY and it never moved and every 2 weeks you did this, you'd get an 18.5% annual return. Not too bad. Not too bad at all considering what bonds are giving you. If you did it just 5 times, you would have $7.50. Remember from our last segment, That's enough to buy that December 2017 call with a $250 strike from our last segment. And that one we think has a good chance to octuple. So if you could do that, if you did this for 5 times, take it 10 weeks, and everything worked out okay, if the SPY just stayed flat, you wouldn't even need it to perform for you. You could afford to have that perhaps octuple in your bag. Okay, so the persistent unattractiveness of the bond market should continue to give support to the stock market because there's no reasonable place else to put your money. And because the market has rallied for the past few years, many people are fearful and willing to pay what turns out to be significant amounts of money to be insured. If they thought about it, they probably would not really want to pay 20% to insure against a loss. Doesn't make much sense, but hey, if you write a lot of short-dated call options, that's what you're getting. Okay, some notes here. Some notes. This first one is a big one. When you are selling calls, when you are writing calls, you want to sell short-dated options. Very important. If you are indeed going to write options, you want to write short-dated options and buy long-dated options. In our example, if you wrote that 24 times a year, you actually are paid more than double if you wrote one long call option. So you could write a call option and say you have the right to buy this from me for the whole year. But if you keep if you keep renewing it every 2 weeks, you get more than double your money. Because what happens is as options approach their expiration, they get cheaper and cheaper until they expire worthless or expire unused. So they're more valuable the more time they give you. That makes sense. Okay, but they do not lose value in a linear fashion. They lose value slowly at first, and then as they get close to their expiration date, they start losing value very quickly. So, my smart, clever, slick friend, when you write short-dated options, you're selling somebody something that's about to lose value very quickly. Aha, pretty good. And when you buy long-dated options, you're buying something that loses value very slowly. So that's big. If you're going to write call options, write short-dated call options. If you're going to buy them, don't buy short-dated unless you can get them for like next to nothing. Buy a long ways out if you can, if that makes sense. Okay, another thing to note here is that this is a great strategy for people, writing call options. This is a great strategy for people that don't watch the market. Writing call options is usually not the very best thing to do in retrospect, but it's never the worst thing to do, and it usually puts you in a good position. So in our first example, when the SPY went to 215, well, you would have just been better off owning the SPY and not writing a call. But you didn't know it was going to go to 215, and you still did well. You ended up in a good situation. That's a pretty typical thing to happen when you write a call. If the market gets killed and you were going to be in the SPY anyway, you're a little better off because your losses were offset by your fee a little bit. Okay, so writing a call option is never the worst option, but it's usually not the very best either. Okay. So if you watch the SPY like a hawk, immediately after doing this, you might say, oh no, I shouldn't have written the call because the SPY is surging. Or you might say, oh no, I shouldn't have even bought the SPY in the first place because now it's getting killed. And so if you're going to watch the stock market, if you're going to watch the SPY really closely every day like a hawk, you're going to drive yourself crazy. So try to do something productive with your 2 weeks, because after 10 sessions, these 3 are up, these 3 are down. You don't want to watch. Okay, so because it doesn't make any sense to watch. Okay, so, and one other note: why aren't you using the VO? We know you like the VO. Why aren't you using the VO? What's this SPY nonsense? The SPY is much more liquid. Its options are much more liquid. If you can pull this off with the VO, go for it. Okay. For the Wall Street exclusive, I'm Joe Springer, helping you make informed decisions. Coming up next, we'll take a look at the cybersecurity stocks, and then we'll take a look at gold. For the Wall Street exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market. Okay, I want to talk about the cybersecurity stocks. Cybersecurity, very big, only going to get bigger and bigger, so people are very excited about these stocks. Have been rallying a lot with the Sony hacks, and all the utilities in America are said to be under constant attack. There was the big breach at Target. Everyone knows this is just the beginning of cybercrime, basically, for the rest of time. So these cybersecurity stocks have been on a tear. There's a lot of upside already factored into them. And so Jim Cramer called these the 4 horsemen of cybersecurity. And so we decided to take a look at them. These are pretty exciting businesses. And so we took a look at CyberArk, the 4 horsemen: CyberArk, FireEye, Fortinet, and Palo Alto Networks. Okay, so here's what we think about all 4 of those, and we'll take them in alphabetical order. CyberArk, Happy Purim CyberArk, Israeli-based company. They don't lose money. They're about to do a secondary. And so maybe, remember we said that after a secondary, right after they announce its close is sometimes the best time to buy? So that could be the case here. They have a lot of growth. CyberArk has a lot of growth. The problem is they've been public for less than half a year and they've already doubled. But we do applaud the company. Their lockup hasn't expired yet, so insiders can't sell yet. And they're doing a secondary before the expiry. And so that means that they're taking care of the business before they're taking care of the individuals, the executives. And we like that. So good for them, CyberArk. It has a lot of growth. We like what management is doing. It's taking care of the balance sheet before taking care of the executives. So that looks pretty shareholder friendly to me. What to do about it? It already doubled. And it's about to put more shares in the market. It's going to do that secondary, and then possibly insiders will sell out as well. So watch to see if it comes in. It looks like a pretty interesting business. So if it does sell off, that CyberArk actually looks pretty interesting. Okay, try to get it at a discount from where it is now. But I would keep an eye on CyberArk. Fortinet is not losing any money. It's not losing money either. Insiders are not selling out in any way that bothers me. But they doubled in the last year. They have 26% revenue growth, but their meager profits actually fell a little. So they already doubled. They're not so compelling. So Fortinet, they're meh. We don't hate them, but they're not very exciting. We're not excited by Fortinet, but we don't hate them either. Then there's Palo Alto Networks. Palo Alto Networks. They are a Wall Street darling. You want to know what a Wall Street darling is? Palo Alto Networks. They have lots of momentum. They're loved by analysts. 11 analysts recently gave them a buy recommendation, very high price targets. But they're a $12 billion company that loses money. But the sales are up over 50% in the most recent report, and the losses that they had only increased by 10%. So eventually they may hit a critical mass there. The insiders were selling at lower levels than this. The problem with Palo Alto is it already tripled in a little over a year. You have to say, you know what, we missed this one. It has healthy growth, but there's so many eyeballs on it from all these analysts. The verdict is Palo Alto Networks' valuation is just too high to justify a money loser that everyone already knows about. And who's left to buy after a triple and after all the analysts that are already covering it? Probably not anybody. So if it sells off from here, we're not going to be too surprised. However, the business underneath actually looks pretty good. So if it does sell off enough, Palo Alto, but we don't think it will. It's valued pretty valuably. Then there's FireEye, a $7 billion company that loses money. It's up only 20% since it came public in 2013. Insiders bailed at double the price. Look at the chart. You'll see where they bailed. It goes straight up. That's where they bailed. As soon as they bailed, the stock got cut in half. So watch for insider selling or buying in this one because they seem to be pretty prophetic about the company. But ignore the growth here in FireEye. The growth is 163% in the last year. Wow, that's amazing. Well, not really, they bought it all. Their loss went from a little over $100 million to almost $500 million from 2013 to 2014. If the insiders buy FireEye, check it out because the insiders seem to have a pretty good idea of what's about to happen to their stock price. There's basically so we really don't like FireEye at all. But CyberArk and Palo Alto may be a little more interesting if their prices ever come back down. So cybersecurity has great tailwinds, but the big verdict there is that mostly they better do well because they're priced to do extremely well. Like you might not be surprised. Okay, I hope you found that helpful. I'm Joe Springer for the Wall Street Exclusive, helping you make informed decisions so you can succeed in the market. Next up, we're going to take a look at gold and why I think gold is actually going to be a pretty good performer from here. For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market. Let's talk about gold. With this negative real interest rate environment, that does two things with gold. One is capital will flow to other assets that are reasonable out of the bond market to the stock market, for example, and to gold as well. Gold's in the stock market. And so the bond market is putting upward pressure on anywhere else you can put your money, including gold. And then number two is that gold's store of value quality becomes that much more appealing in a negative real interest rate environment. It's like, hey, just don't lose money. Gold at least isn't definitely going to lose purchasing powers like dollars in a negative real interest rate environment. Okay. So gold yields nothing, it does nothing, it does not have income, does not do business, and generally speaking, we'd like to see it in businesses better. Businesses are better, they make money, they compound, who knows what's gonna happen with gold. So generally speaking, we still like stocks of businesses better, but we actually think gold is going to do well from here, and largely because of the negative real interest rates. So, and then like we said with the S&P 500, the way to play gold, we think, is to buy the GLD and then sell calls, short-dated calls against it. Gold just closed at 115.11, the GLD. You can sell the 116 strike. It traded today for $1.11. That comes out to 0.96% in 2 weeks. Okay, and so that if you did that all year long, you would get a 26% return on GLD. That's pretty good. So for considering gold doesn't have a dividend, doesn't do all that, and considering it's sold off a whole bunch, and now it seems to be pretty good at 1,200, and the bond market making anything that is reasonable is going to get funded pretty well. And so if you buy the GLD and then sell one strike above where it is, so it's at like so it's at like 115 or we're at 115 something, so sell the 116. That's a good strategy. You can still get a little bit of appreciation, and you can get your fee. There was a back test of the S&P 500. That was the best way to play it, but just in general, it makes sense as well. So because of the negative real interest rate environment, because the Federal Reserve is doing its job and making bonds unattractive, other asset classes are gonna do well, including gold, we think. And gold is nobody knows what's gonna happen with gold. So selling insurance on gold, 26% a year, is terrific for gold. I mean, gold is just, people are happy if it just sits there and does nothing. Okay, I hope you found that helpful. I'm Joe Springer for the Wall Street Exclusive, helping you make informed decisions so you can succeed in the market. See you tomorrow.